What's going on, everyone? Welcome to another round of multiple choice questions here. Today we've got questions on accounting changes and error corrections. Let's see what we're going to do in each situation. All right. Althouse Company discovered that equipment purchased on January 2nd for $150,000 was incorrectly expensed at the time. Well, we see it was expensed incorrectly. That's the incorrect treatment, right? Because when you purchase equipment, what do you do with it? You capitalize it and then depreciate it, so not expensed. The equipment should have been depreciated over 5 years with no salvage value. What amount, if any, should be adjusted to Althouse's depreciation expense at January 2nd, the beginning of the third year, when the error was discovered? Let's think about the treatment here. So this is an error. This is not an accounting change. It's not an accounting treatment or a policy. This is just simply an error. The thing with depreciation, and let's say you think about an error like this, or if the estimated remaining useful life changes, anything with depreciation is going to be, I'll give you a second to think about it. What's the treatment here? That is going to be reset, right? Reset, you are going to treat it like it's starting right now, whenever you discovered the error or changed the estimated useful life. So meaning when the error was discovered at the beginning of the year, it's going to be $0. The depreciation expense will not have any amount, will not have a balance, but you're going to start it right now. So if it asked us in a month, February 1st, that would be 1 month of depreciation for the asset there. Final answer is going to be letter D, $0. So more of a kind of thinking this through, not so much math, just little tricks, and practice. You all will get this. All right, next up here. When there is a change in the reporting entity, how should the change be reported in the financial statements? Okay, this is the reporting entity. So this is the name on the top of the financials. This is ABC Inc. This is Microsoft Incorporated. This is Walmart, whatever that big name is. And when there's a change in the reporting entity, so maybe there's an acquisition, maybe there's a merger, maybe there's any sort of instance where the name on the top is going to be significantly changed because it's not the same company that it once was. Even if it by name it is, it's still a different company. For whatever reason. Again, all of those are valid reasons. All right, so are we going to simply just disclose it? I'm going to say no. I mean, that's pretty significant. That's pretty significant. We're not going to simply disclose it. All right, so do you report? So reporting means actually doing something with the numbers. So, all right, these are more possible answers. Currently, so do you report it currently? Well, not currently. We need to do even more than that. We need to do a lot here, essentially. Do we do it prospectively, meaning going forward? We will, going forward. However, the real kicker here is that not only do we have to do it currently and prospectively, by saying we got to do it retrospectively, that essentially alludes to for all time, right? For all time, we are going to treat it like this was how the reporting entity should be. So retrospectively, including note disclosures, an application to all prior period financial statements presented. So we do everything, right? Report, we disclose, we talk about it, we show the numbers, we treat it as if, so let's say Costco and Walmart merged, we need to now issue financial statements for all of the prior periods, essentially merged financial statements between the two of them all the way back, currently, and going forward, because that's the new entity, right? That's the new consolidated entity. Awesome. Great section here. Practice the questions and you will all do just fine. Thank you for joining, and I'll see you in the next one.